So now we're moving on to chapter 3. We're going to be getting into taxes, and I will try to tread lightly here to move on at kind of a rapid pace because it gets into great detail as we go through this taxes, because taxes can become quite complicated. For most people, not quite so complicated, but nonetheless, taxes certainly affect your financial planning because there's a good portion of your income that goes into taxes. Your income less taxes, less the taxes in terms of payroll taxes. Payroll taxes would include withholding tax, state and federal. Also would include Social Security, and your Medicare taxes would be taken out. Those are payroll taxes, considered payroll taxes. There are other taxes that your employer would be paying, but we'll kind of leave it at that for the moment. So we have our 3 learning objectives, and we're looking at taxes in reference to our financial plan. First, identify the major tax types in our society. 2, calculate the taxable income and the amount owed for federal income tax. 3, prepare a federal income tax return. 4, select appropriate tax strategies for various life situations. So first off, keep in mind that the tax structure has changed since federal taxes have changed slightly since this was put into place. But at any rate, since this was published. So first, we're going to identify the major taxes paid by people in our society. Planning your tax strategy from that. Start planning for taxes. Always have some idea of what your taxes are, what taxes are, how they're going to impact you. It's very important. So know current tax laws as they affect you. Maintain complete and appropriate tax records. Make purchase and investment decisions that reduce your tax liability or limit your tax liability as much as you can, of course. The goal is to pay your fair share of tax, but pay no more than that. There was a judge, a federal judge. His name was Learned Hand. Great name, isn't it? Learned Hand. Learned. Learned Hand was the last name, like the state of Michigan, your hand holding it in front of you. And he basically said, is it pay your fair share of taxes, but no more. That's what you're obliged to pay, so that's what you pay. So onward. So of course there are different types of taxes or incidents of taxes, if you will, where the taxes are levied, where they actually occur, who's paying those taxes, and so on and so forth. So taxes on purchases would be sales taxes and excise taxes. Excise taxes would be taxes that typically are with the sale of tires, and on your cell phone bill there are typically excise taxes. 2 would be taxes on property, real estate taxes, personal property taxes, your paying taxes on your vehicle registration, and so on and so forth. 3rd would be taxes on your wealth, the estate taxes, inheritance taxes, and taxes on your income, on your earnings rather, income taxes, Social Security. So now we're calculating our taxable income and the amount of owed, again, the federal income level. So these are income tax level. So these numbers do change, so just to let you know. But the first step is trying to determine your AGI. AGI is equal to your adjusted gross income. So what you're doing is you're trying to reduce, to identify where what your taxable income is. That's the adjusted gross income. And we'll get into that with exclusions and so on and so forth. So you take your taxable income. Net income is equal to income which tax is computed. Gross income minus allowable deductions. That is what drives us down to that adjusted gross income. So the main components of gross income: earned income, including wages, salaries, commissions, fees, tips, and bonuses; investment income, money received in the form of dividends, interest, or rent from investments. A lot of these things would be foreign to you. I mean, we typically, especially when you're young, you don't see things as dividends or interest payments, interest receiving income, interest income, or rent from investments, etc. Typically we're talking about wages. Nonetheless, it's important to kind of get an idea, to get your head wrapped around what we mean by income. So again, passive income results from business activities in which you do not directly participate, such as a limited partnership. Other income would be alimony awards, lottery winnings and prizes you win at the casino, etc. You get the idea. So total income is affected by first exclusions. Exclusions are amounts excluded from gross income. That's what I was referring to before. Also referred to as tax-exempt income. Income not subject to federal income tax. Example of that would be interest on most state and city bonds. So municipal bonds, bonds on municipalities, cities, and/or states. You know that when they borrow, you're not subject to federal income tax. So this is where exclusions would come in. Tax-deferred income. That would be if you were saving and you set money into your IRA, your individual retirement account, for example. And again, we'll get into these later in the class, but you're not subject to tax at that point in time. But later on, when you try to get the income that resulted from those investments, then you would be taxed, and you would be taxed as normal income. So this is tax-deferred income. Adjusted gross income, again, the gross income reduced by a certain amount of adjustments described below. Adjustments to income would, the objective, of course, is to trying to reduce the AGI, contributions to traditional IRA or KEO plans, alimony payments. These reduce your adjusted gross income, the amount that you're actually going to be taxed on. A tax shelter is an investment that provides immediate tax benefits. You're being, just as the name implies, you're sheltering, you're avoiding taxes, okay? You're not evading taxes, you're avoiding taxes. These are legal things that we're considering here, keeping that in mind, okay? So taxable income, step 2, computing your actual taxable income. Tax deductions are equal to the amount subtracted from your AGI to arrive at taxable income. To start with, we have our standard deduction, or we have itemized deductions. Standard deduction is what everybody gets. And itemized deductions are if we have expenses that exceed that standard deduction, we can reduce our taxable income or our tax burden through that. Okay, so calculate taxable income in terms of the itemized deductions. So if you have medical and dental expenses in excess of 10% of your adjusted gross income, those are deductible. Okay, taxes that you would pay to to state, to property taxes, etc., interest, certain types of interest, contributions, donations, certainly, casualty and theft losses, moving expenses, job-related and other miscellaneous expenses. Typically, job-related moving expenses associated with job searches and so on and so forth. You're relocating for a new job. You can write that off. Those are itemized. Those are deductible deductions that you can take, again, to reduce your tax liability. Taxable income exemptions. Exemptions are subtracted from AGI. An exemption is, again, a deduction for yourself, your spouse, or qualified dependents. The amount of exemptions for this is 2014, so these are different. We'll get into this. I don't have the specific numbers, but this goes back obviously quite a ways. 2014 was $3,950 per person. After deducting exemptions, you would have your taxable income. All right. So tax record keeping system, very important. Tax forms and filing information. Most people keep these on their computers, but you also have to have backups, meaning that you should definitely have hard copies. In terms of, especially in terms of expenses, if you itemize your deductions, you should definitely have, you should definitely keep track of those individual expense items. And you should have a hard copy of those. If not, nothing else, then you should scan those bills, etc., medical bills, and keep copies of them on your computer for that given tax year. Anyway, income records, of course, your W-2 forms and so on and so forth. Your 1099 forms are whether we're talking about interest, dividends, capital gains, any kind of a 1099 forms that does not take out Social Security, for example, you definitely want to have records of that. And back to, again, the expense records, receipts for medical care, etc. You definitely want to have that. So calculating your taxes you owed is step 3, calculating tax owed. Tax rates are equal to marginal rates. Remember now, when we talk about marginal, we'll walk through this, but the idea is that, say, for example, you're earning $50,000 a year. Sounds good. So you're earning $50,000 a year. The first portion of that income, we'll say $15,000, you're paying federal taxes to the tune of 10%. So for the first $15,000, 10%. For the next $25,000, so from $15,000 up to $40,000, you're paying 15%. And for that last portion, from $40,000 to $50,000, you're paying 20%. So that's what we mean by marginal taxes. So you're paying at a certain rate kind of going forward. So again, these tax table rates, they'll show the marginal rates. Tax rate paid on last or next dollar of taxable income. Okay. Example, after deductions and exemptions, person in the 35% bracket pays 35 cents in taxes for every dollar of taxable income within that framework of that bracket. So these are, again, the 2014 IRS tax brackets. So for a single payer up to $9,000, it was 10%. From $9,076 up to $36,900, it was 15%. So on and so forth. That's what they mean by marginal. How much you're paying on that chunk of your total income. These are old numbers. I should have something updated for you, but it's something that you can readily get your hands on, and it's something that's going to be changing going forward. So always keep that in mind. Tax rates are available, and it's the reason that you are going to want to keep an eye on this is because when you move from one tax rate to another, remember that chunk of income that you have. For example, you're earning $36,900. So the next dollar of income that you earn is going to be taxed not at 15%, but at 25%. Always keep that in mind. So this walks through an example. Someone with $90,000, again, nice income, $90,000 for a married couple, and the tax liability, how much they would expect to owe kind of going forward. So they're showing that marginal rate that they're paying is 25% for a decent chunk of their income. However, or for a portion of their income, the average rate, or the effective rate as it's referred to, is significantly lower. This is typical for most income earners, is that your effective rate is significantly lower than your overall rate, or rather than your marginal rate, the highest rate that you're paying. So average and marginal tax rates, average rate is equal to the total divided by the taxable income, total taxable income. And again, the average tax rate is less than the marginal tax rate typically, all right? Alternative minimum taxes paid by taxpayers with higher amounts of certain deductions and various types of income designed to ensure that everybody pays their fair share of taxes, A&T. Tax credits, these are things that immediately reduce your taxable income, not deductions, not a portion of it, but reduces it dollar for dollar, if you will. Earned income credits, foreign tax credits, child care dependent credits, care credits, savers and the credits, the formerly retirement tax credits, adoption tax credits, education credits to offset college education expenses. Again, a lot of these things have changed, but for the most part, they're still out there. I'm not sure about the savers credit, if it's out there still, but at any rate. Tax credit versus deduction, again, $100 tax credit reduces your taxes by $100. $100 tax deduction reduces the amount of tax based on your tax bracket. So if you're in the 25% tax bracket, you have a reduction for $100. You reduce your tax burden by $25 or 25%. Determining your tax liability. This is a walkthrough, and these are important. I'm not going to go through this. You can go through these on your own. You can pause it at this point and walk through yourself, because again, I don't want to get too much in the weeds on this. It's important to understand how the taxes work and the flow, but this is something that you can walk through on your own. So step 4, making tax payments, payroll, withholding. These are taken off right off the top. The payroll withholding tax is the amount that, depending upon how much you want to have taken out prior to, based on the number of exemptions, how many people that you're accounting for and expected deductions claimed, people that are dependents of you, yours, etc. And if you underpay too much, or if you're getting more income and it's not being taxed for that period of time, you want to pay your taxes on a quarterly basis. This is very important, because if you don't, what will happen is you'll end up with a huge tax bill at the end of the year, for one. Plus, if you don't pay your taxes, again, this withholding taxes, if you don't pay taxes within that quarter, you oftentimes end up with a significant penalty. Then here we go, deadlines and penalties. These are very straightforward, again, to walk through to understand what we're talking about. Penalties and interest. Underpayment of quarterly estimated tax may require paying interest on the amount owed. And penalties can also ensue as a result. And it goes well beyond fraud. It could be penalties are levied for any reason, really. So 5 filing status categories: single, married, filing jointly, married filing separately, head of household, unmarried individual or surviving spouse with a child or dependent relative, qualifying widow or widower with dependent, with a dependent. Okay. So which forms do you use? There are 800, wow, approximately 800 federal tax forms and schedules. Basically, for most people, the EZ or the 1040A, which is very straightforward. A good portion, I didn't realize this, use the 1040, the long form. Which form you use depends upon how involved your taxes are, is really what it comes down to. Completing your federal income tax return, filing status and exemptions, income adjustments to income, tax computation, tax credits, other taxes such as from self-employment, meaning the self-employment piece would be how much you're paying into for Social Security. Because Social Security, as you realize, whether you realize it or not, for Social Security and Medicare, I think it's 6.25% of your income. Whatever your income is, 6.25% on top of that, or a portion thereof. Rather, it goes toward Social Security, and another 1.45% gets kicked into Medicare. Your employer is also on the hook for that. That's 6.25 and then 1.45 for Medicare. 6.25 for Social Security, 1.45 for Medicare. Takeaway from that is that if you're self-employed, you've got to pay both sides of that yourself. Anyway, that's now completing the federal income tax return. And again, this is just walking through what you're supposed to do. And a lot of these things are done completely online with such things as TurboTax, or if you have a tax preparer. So not that it's antiquated, but this kind of gives you the nuts and bolts of how you walk through completing the tax form. State taxes. Michigan has a 4% income tax rate, for example. And it's, again, state of Michigan, the tax filing date, not this year because of COVID, but the tax filing date is typically April 15th or the first Monday, if it happens on a weekend, the Monday after the 15th, if you will. And the state of Michigan, I think it's on the 30th of the month, or the 30th of April, or maybe the 15th, I forget now. How do I file my taxes online? H&R Block, TurboTax. There's a cost for e-filing, of course, and I won't belabor this one. Selecting tax software. I myself typically just get TurboTax, and I don't have a very complicated system, but I just use the TurboTax. it costs a bit, but I just use that, and I have been using it for the last probably 10, 15 years. Filing taxes online, again, this is all very straightforward, and it walks you through this, and you can file, and you can file free, if you will, for the, through the IRS. But anyways, there are things that kind of go along with it. There are assistants that are out there, but the software itself is pretty straightforward. It's pretty much not very complicated at all. Tax assistance sources, etc., preparation services. For most people, they can file their taxes on their own. If it gets complicated, oftentimes you would probably want to have someone prepare for you, a CPA or an accountant of some sort, a bookkeeper type of somebody that specializes in tax returns, or even an H&R Block type of a situation where they basically walk you through all the different options, to cover, your expenses all the way through. Evaluating the tax services, this is, again, word of mouth is probably, I've used one time, I've used a tax preparer, someone to help me prepare taxes, and that was through a friend of mine that had suggested, and it turned out okay, so far as I know. So onward we go. Tax service warning, you have to be careful of any of this stuff out there. So this is again why it would probably be in your best interest to try to do the taxes yourself, through one of those, through TurboTax, etc. And if you're audited, again, your audit is less than 1% of all returns are audited. And that comes if you have huge, some deductions that are kind of off the charts, if you will. And it's unusual, but oftentimes from what I've seen, I've never been audited myself, but from a family member that had been audited, was that once they're audited, if they're audited once, they tend to be audited over and over again. So it's something to kind of keep in mind. It's nothing to be scared of. You just have to keep track. You have to keep records. It's very important. So again, you have rights to the rights that go along with this. You have to present your case. You have to present, this is why it pays to be honest when you file your taxes. These audits are nothing to be scared of, but nonetheless, you have to have all of your documentation. Mistakes happen. For the most part, you can pretty much avoid audits by sticking with the rules and keeping track of your expenses and making sure that you're not going overboard. Practicing tax avoidance. Remember, it's avoidance, not evasion. Avoidance, not evasion. You avoid taxes. You only pay your fair share of taxes, but just avoid evading taxes, because that's a heck of a thing to have hanging over your head. Tax planning strategies, if you expect the same or lower rate next year, these are things that on a case-by-case basis. For the most part, most people don't have to be concerned about these things until there are major changes in your life. And at any rate, and if things change over the course of a year, you can always change how much is being taken out of your check, etc. That's kind of walking through the different processes in this matrix. Consumer purchasing, home ownership, one of the best tax shelters, deduct mortgage loan interest and property taxes, reduce your taxable income. And now with rules that have changed, we won't get into it here, but it's still out there, but it's not really available for everyone as it kind of was in the past. And again, home equity lines of credit, this is something important to kind of keep in mind, is that interest is deductible. All interest you pay on mortgages, whether you're talking about home equity line of credit or refinance or whatnot, they are deductible, but there are limits on that because the standard deduction has changed significantly. Tax planning strategy, job-related expenses may be allowed as itemized deductions, union dues, business tools, job search costs, healthcare expense such as FSA, for example, allow you to reduce your taxable income when paying for health-related expenses. But remember now, this is out of pocket. these are after-tax dollars that you're using for your healthcare expenses. So always keep that in mind, and you have to have, I believe it was in excess of 10% to do this. Tax-exempt investment, municipal bonds, tax-deferred investments, your IRA. And we'll get into this, but there are different strategies so far as IRAs are concerned, where it's after-tax investment, Roth IRA, or before-tax investment, which is the traditional IRA. That's the tax-deferred. Capital gains, this has to do with gains in terms of, like, if you bought Apple stock a couple years ago versus the value of Apple stock today. If you were to sell that stock today, what you would do is you would realize what's called a capital gain, the gain in the value of that share of stock. This share of stock went up in value, and the difference between the purchase price and what you're getting is a capital gain. And we'll talk about that again as we kind of go forward. Self-employment, this is the disadvantage. The advantage, of course, is you control things much better if you're doing everything on your own. The disadvantage is that you have to pay additional taxes that we identified as those payroll taxes, the half that your employer would typically pay for Social Security and Medicare. So tax planning strategies, children's investment, this is where you would invest for children for school, etc., and education plans, and so on and so forth. This is something, I'm not sure if this has changed or not, but the children's investment under $2,000 qualifies for a $1,000 deduction with remainder taxed at the child's rate. So this is limiting the amount that's kicked in for children. And again, the retirement education accounts, it's the traditional IRA, the Roth IRA, education IRA, and the KEO and 401k. That's through employers, if you will, the 401k. Retirement plans are traditional IRA and the Roth IRA. Traditional IRA is pre-tax, where you're taxed later on, and the Roth IRA are not taxable. And so the key here, of course, is that when they talk about withdrawing, you have to wait until you're 59 and a half to withdraw your IRA, to take money out of your IRA without getting a tax penalty on that. Whereas with the Roth, that's not necessarily the case. There's some specific rules that go along with it, but in general, the IRA is it's great. The Roth is even better in terms of you're basically paying your taxes up front, and whatever your money grows at going forward, however it increases over that period of time between now and the time that you would actually withdraw it after age 59 and a half, you wouldn't be paying any income tax on that portion after. Educational savings account, kindergarten through college age, the 529 plans, these are all different plans that are associated with retirement, and also educational savings accounts. So the 401k is tax-deferred retirement plan through your work. KEO is the version for self-employed. And there are changes all the time coming through the IRS and things to consider, and there are changes from when this was actually published to now as well. Flat tax or VAT tax is something that you get into different arguments with people about paying flat taxes, the rationale behind that versus a value-added tax, and we won't go there in this class. So just again to summarize very quickly, tax planning is important, and you have to be aware of what your tax liabilities are. Whatever the case may be. So understanding what that means in terms like moving from your income grows by a certain amount, you move into a new tax bracket. What are the implications? What's involved with it? Again, walking through in the summary, taxable income is determined by subtracting adjustments, and this is where we get to the HEI, etc. Your total tax liability is based on the tax tables, which are changing. They change from going forward from 2018 onward. Now they're a different level than they were when this was first published in 2014. So the major sections of the 1040 provide the basic framework for filing your income tax, your federal income tax in particular. State is very similar. There are a lot of different ways to doing it. You can use a TurboTax type of software, etc. So again, the takeaway on taxes is that taxes should not rule your life, but at the same time, you have to consider the ramification, what's involved with taxes, because remember now your income goes to can go to paying for things, consumption, consuming things. It can go to saving, and whatever is, I should do it the other way around. Whatever you're spending, consuming, and taxes, and whatever's left over, it goes to what? Saving, right? So it has a tremendous impact on what you're able to spend, taxes, and how much you're able to save. That's it.